Ever wondered if a stock is potentially undervalued or overvalued compared to the company's actual net worth on paper? The P/B ratio can give you clues. First up, what exactly is book value? Think of book value as a company's net worth according to its accounting records, or books. It's calculated by taking the company's total assets and subtracting its total liabilities. Essentially, if a company sold all its assets and paid off all its debts today, the book value is the amount that would be left over for shareholders. It's based on historical costs and accounting figures found on the company's balance sheet. Now let's connect this to the market with the price-to-book ratio. The P/B ratio compares a company's current market value, the stock market thinks the company is worth, to its book value. It tells you how much investors are currently paying for each dollar of a company's net assets. How do we calculate it? There are two common ways. Method 1. You can take the company's total market capitalization and divide it by the company's total book value. Method 2. You can calculate it on a per share basis. Take the current market price per share and divide it by the book value per share. To get the book value per share, you simply take the total book value, that's assets, subtract liabilities, and divide it by the total number of outstanding shares. Both methods give you the same P/B ratio. Okay, so we have this ratio, and what does it mean? Generally speaking, a P/B ratio below 1 suggests the stock might be undervalued. Investors are paying less than the company's stated net worth for each share. A P/B ratio above 1 suggests the stock might be overvalued, or at least trading at a premium to its book value. Investors are willing to pay more than the net assets value per share, perhaps due to expectations of future growth or strong earnings. But context is crucial. A low P/B ratio isn't automatically a buy signal. The company could be in financial trouble. A high P/B ratio doesn't automatically bad. High growth companies often trade at a premium. It's vital to compare a company's P/B ratio to its historical levels and to other companies in the same industry, as typical P/B ratio vary significantly across sectors. For example, asset-heavy industries like banking or manufacturing often have lower P/B ratios than tech companies with fewer tangible assets. Let's walk through a quick example. Imagine a company called ABC. Its total assets is $15 million. Total liabilities is $30 million. Outstanding shares are 5 million. Current stock price is $6 per share. First, let's calculate the book value. 50 million minus 30 million equals to 20 million. Now let's find the book value per share. 20 million divided by 5 million equals to $4 per share. Finally, calculate the P/B ratio. That's 6 divided by 4 equals 1.5. So company ABC has a P/B ratio of 1.5. This means investors are paying $1.5 for every $1 of the company's book value. You would then compare this 1.5 to its peers or historical levels to get more context. Why should investors even bother with the P/B ratio? Identify potential undervaluation. It's a classic tool for value investors looking for stocks trading below their net assets value. Comparing companies. It's useful for comparing valuations of similar companies within the same industry, especially those with significant tangible assets. reality check. It grounds the valuation in the company's balance sheet assets, offering a different perspective than earning-based ratios. However, the P/B ratio isn't perfect. It has limitations, like ignores intangible assets. Book value primarily reflects tangible assets, like buildings, equipment. It doesn't capture the value of intangible assets, like brand reputation, patents, or intellectual property, which are crucial for many modern companies, especially tech or service firms. This makes P/B less relevant for these types of businesses. Accounting differences. Book value is based on accounting standards and historical costs, which might not reflect the true current market value of assets. Accounting practices can also differ. Doesn't reflect debt levels directly. While liabilities are subtracted to get book value, the ratio itself doesn't highlight the level of debt or a company's earning power. And how does P/B ratio different from the P/E ratio? P/B compares price to net assets, while P/B compares price to earnings. P/B is often more stable than P/E and useful for asset-heavy companies or those with inconsistent earnings. P/E is often preferred for growth companies where earnings potentially is key. Many investors use both and other metrics for a fuller picture. The P/B ratio is a valuable tool in your investment analysis toolkit, but it shouldn't be used in isolation. Combine it with other financial ratios and qualitative analysis for a well-rounded view. Hope this explanation helped clarify book value and the price to book ratio. If you found this video useful, give it a thumbs up, subscribe for more financial insights, and let me know in the comments if you use the P/B ratio in your own analysis.